China's Dalian Commodity Exchange began trading soybean futures contracts in 1993. Later, due to changes in national policies and the spot market, soybean futures were gradually replaced by soybean number 1 and soybean number 2 futures contracts. The underlying of the yellow soybean number 1 futures contract is edible non-GMO soybeans. At present, China, Russia, and other countries are the world's major producers of non-GMO soybeans, but they are basically used to meet domestic demand, and the cross-border trade volume is relatively low. My country is a major producer of non-GMO soybeans, but with the increasing domestic demand, China also imports non-GMO soybeans from Russia, Ukraine, and other countries. In my country, non-GMO soybeans are mainly used for food processing, such as tofu and soy sauce. Non-GMO soybeans are mainly used for food processing, such as tofu, soy sauce. Yellow soybean number 1 futures were listed in 2002. Since its listing, it has been running steadily and trading has been active. The participation rate of relevant real enterprises is relatively high. It has become an important pricing tool in the domestic soybean spot market. Soybean 2 futures contract is for crushing soybeans. The contract is mainly against the import of genetically modified soybeans. Currently, Brazil, the United States, and Argentina are the world's main producers of GM soybeans, together accounting for about 80% of total global soybean exports. Imported GM soybeans are mainly used for crushing to obtain both soybean meal and soybean oil. Soybean meal is used for animal feed, while soybean oil is used as cooking oil. Soybean 2 futures were listed in 2004, and the contract is now running steadily, and the market function is playing well. In 2016, relevant national policy support was secured to provide convenient measures for the participation of imported soybeans in futures delivery. Soybean 2 contract design fits the actual situation of the spot market, fully meets the industry's risk management needs, and will play an important role in maintaining national food security and promoting the healthy development of the industry. In the 1980s and 1990s, soybean prices were stable with occasional spikes due to weather disruptions and agricultural policy changes. The 2008 financial crisis caused a sharp drop in prices, but rebounded due to demand recovery and supply constraints. The COVID-19 pandemic has continued to impact soybean prices, with bull markets causing surges due to high demand, supply constraints, and rising input costs. You might be wondering how to figure out the right futures price, so the formula is this. This is why you will find different futures prices for different maturities on the futures exchange, because T is one of the factors. Another very important factor is the spot price, which is mainly determined by demand and supply. Generally speaking, for demand, an increase in the demand for goods leads to an increase in price, while for supply, an increase in the supply of goods leads to a decrease in price. Supply and demand for soybeans follow the same pattern. China's soybean supply mainly depends on soybean production. Currently, the world's major soybean producers are the United States, Brazil, Argentina, and China. China's soybean demand is mainly divided into oil consumption, food and other industrial consumption, seed use, and export. The above figure shows the import and export statistics of soybeans from the National Bureau of Statistics of China. From the chart information, China's demand for soybeans continues to grow, and although domestic production has increased, it still needs to rely on large-scale imports to meet demand. Climates play a pivotal role in soybean production. Favorable weather during planting and growing seasons can lead to abundant crops, resulting in lower prices due to increased supply. Conversely, unfavorable weather conditions, such as droughts or excessive rainfall, can diminish yields and escalate prices. Key producing regions, like Heilongjiang, are particularly influential. For instance, droughts in these regions often trigger price spikes due to reduced yields. From the above figure, we can analyze the crushing consumption and edible consumption in the consumption category. Crushing consumption represents the consumption of soybeans used for oil pressing. From 90.54 million tons in 2021-2022, it is expected to reach 97.78 million tons in December 2023-2024. This shows that the crushing consumption is showing a steady growth trend. The consumption of edible soybeans from 2022-2023 to 2024 is expected to increase by 680,000 tons to 15 million tons. This growth reflects the popularity of soy foods in the diet and the trend that soybean sales will continue to increase. From this, we can see that supply and consumption have a huge impact on the price of soybean futures. However, the cost of holding future is indispensable. It is the cost-price increase caused by realistic factors that farmers need to consider. For example, when transportation costs increase, tariffs will increase. When demand increases, the amount of planting will increase, and storage costs will increase. Finally, bad weather will lead to increased insurance costs. So when we calculate the soybean futures price, this holding cost is also a factor we need to consider. So after the last formula, we need to add a cost. Soybean is an important agricultural and industrial raw material in China, and DCE soybean futures are the main commodity futures variety in China, playing a key role in price discovery and risk management. The DCE soybean futures market is highly correlated with the global soybean market, and the DCE soybean futures price is strongly correlated with the global soybean market price. Due to the high degree of internationalization of global soybean trade, DCE soybean futures price changes can usually reflect the international market situation, providing an effective price signal for upstream and downstream enterprises. But at the same time, due to the complexity of Sino-US trade relations, trade policy changes will also have a significant impact on DCE soybean futures prices, increasing the price risk of enterprises. Therefore, the rational use of futures tools for risk management is particularly important. Soybean futures are a robust risk management tool, particularly crucial in mitigating the volatility inherent in agricultural markets. For farmers, the unpredictability of market prices poses significant risks to their revenue stability. Farmers can secure selling prices in advance by utilizing soybean futures, effectively hedging against potential downturns in market prices. This strategic approach safeguards the financial value of their harvest. For agribusinesses and food processors, soybean futures are indispensable for managing cost volatility. This proactive risk management through futures contracts allows businesses to maintain operational efficiency and profitability, irrespective of price swings in the raw material markets. These entities can stabilize their input costs by locking in future purchase prices, ensuring consistent profit margins despite market fluctuations. Accessing the futures market is now more convenient than ever before. Consider a practical scenario. You are buying soybean futures at $10 per bushel when prices are low. If the market prices rise to $12 per bushel, you can now sell your futures contract and secure profits. This strategy allows you to capitalize on market movements while managing risk exposure. Diversifying your investment portfolio can further reduce risks. By spreading your investments across various commodities and financial instruments, you can mitigate the impact of adverse price movements in any market. Staying informed is the key to successful trading. Utilizing the analysis tools available on your trading platform can help you review market trends, expert opinions, and historical data. This will help you anticipate price movements and adjust your strategies accordingly. With soybean futures, you now have the tools to effectively manage investment risks, secure your financial prospects, and take advantage of market opportunities.